Price indicator divergences are one of the most popular trading strategies out there. This is when price makes a new low, but the indicator fails to make a new low, signaling a reversal to the upside. Equally, we can have it if price makes a new high, but the indicator fails to make a new high. Then we can expect a reversal to the downside. At least this is the theory. This week I have been analysing price indicator divergences. I've done loads of work. I've looked at the daily, I've looked at multiple time frames, I've looked at multiple markets, and in this video I am going to share my results. Well, I am fascinated to see how the theory of trading strategies, price divergence, matches up with the results. So I put together a model that you can see on this screen. This is a Tradinformed backtest model. In fact, it is the Tradinformed members backtest model that I have shared this week with my membership group, and there is information below this video if you'd like to learn more about that and get this spreadsheet that I am demonstrating. Now, I'm only going to demonstrate on the daily time frame. I have looked at other time frames and I'm happy to share those results in a later video. I've already shared them with my members, but you can see what is going on here. So I've got the Spider ETF, tracks the S&P 500, a great market for all sorts of different patterns and technical analysis, a really good market to trade. RSI and OBV. So I'm going to give you an advanced bit of information. RSI worked much better because I believe it is a bounded indicator. This means it can only go between 0 and 100, whereas OBV is unbounded, which means it does not show the reversals as clearly as RSI does. So it doesn't show the price divergences as clearly as RSI, and consequently we get fewer trades and we don't get as good results. So I'm going to show you the results for RSI first. So you can see, I'm going to zoom in here. This is one of the key settings that I have highlighted with my cursor here, minimum preceding price fall in bars. Now this is fractal, we could use it on the daily, weekly, minute, half an hour time frame, it doesn't matter, but there's got to be space to the left of this low. So if I've set it here to 40, it means we need to be at a 40 bar low. So it's quite a significant fall in price. If I put it to 4, we would only need to have 4 bars to the left of it clear. There's always 1 bar to the right, so we're working on the basis of a small uptick to form the low. The next thing that I'm doing here is the maximum number of bars between the lows. Now I've put a rough formula to say that the smaller the price fall, the less significant it is. In other words, the pattern is going to expire out after roughly 4 times as many bars. Whereas if I put in, like I had a moment ago, so I put in 20 bars, then we're going to say that pattern is going to stay valid for 80 bars. Now you can adjust this. I'm just putting in a rough value to make something that looks proportionate to what we see on the chart. I've also got a filter, and I will show you that in a moment. So I'm zooming out here. I've kept this neutral, so I'm not showing a profit target or a stop loss. The only close that I'm using is a time close. Now this is an excellent way to test your strategies, to actually use in your trading if you're using a pattern and event-based entry signal. So we are using a pattern-based signal here, and we would assume if this pattern is valid, that pattern is only going to stay valid for a certain amount of time. So I could push that forward to 10. I'll zoom in here again. 15, this means that the strategy will automatically shut down after 15 days. If I put it up to 20, 25, you can see we're getting to roughly the sweet spot here. And if I show you, I'm going to zoom in here to the results. You see my average trade expectancy on about 25 days is 1.8% thereabouts in the underlying market. And percentage time in the market, which is another crucial thing, is 8%. This means that you are only invested 8% of the time, which means that you have capital available to make other trades. So it is a good thing to have a high win rate strategy that maybe doesn't trade very frequently. We don't see good divergences very often, but it's there when you need it, and you can keep your capital available for other trading strategies. Now let's zoom back out. Let's have a look at the results that I was getting. Crucial thing I was seeing here in more or less all the scenarios with the SPY is a good percentage of winning trades. Now I'm going to zoom in here. Okay, so percentage of winning trades here, 78%. That's pretty good. That is pretty good. So we are in a reversal format, but we're only using the time close. Stop loss is going to reduce our percentage winning trades, but we hope it's going to increase our net profit by cutting our losing trades. And indeed, it does pretty well in many of the scenarios. If I'm going to put this back to say a 10 bar low, you can see here we get a good advantage from the stop loss. Now I'm using the ATR as a stop loss. Now I've said I've tested different markets. You can see here I have tested 3 of the big index ETFs, SPY, Qs, IWM, of which Qs is the notably poor performer. I'm thinking with the testing I've done so far on different time frames, this is fractal, so it is surprising how well this correlates with different time frame. If you're interested in the 15-minute time frame, that is where I started. Qs didn't perform well on that either. I think my theory is that QQQ has a tendency to overshoot. It's such a momentum market that people get overexcited and over fearful too quickly, and so these reversals, these price indicated divergences, don't work well enough because the price is going to overshoot to the downside. Seems to be the case. However, other markets perform pretty well. I've got a range here of the S&P 500 sectors plus emerging markets at the end. Pretty solid. And I'm just going to run my cursor over here, and that gives us a simple mean average. It's a very rough way of looking at the overall profitability of each of these markets, a simple moving average of the percentage number of winning trades, and it's 64%. So that is pretty good, and I'm excluding the SPY where I've done my initial analysis, but that seems to work about the best, along with XLB, and XLU has worked pretty well as well on different time frames. Now, I think it's because the indicators that have the most tendency to reverse will work better on this. So the strongly trending ones like the Qs, like XLK as well, particularly, although it's showing decent results, are not going to work as well on this sort of divergence. I said earlier in the video that I was going to look at OBV, and that is what is showing on the screen now. In fact, you can flick between RSI and OBV just using this checkbox here. So the biggest problem I found with OBV is we are getting fewer trades. In fact, we're getting pretty decent results for the small number of trades that we're showing here. Good trade expectancy. And if I adjust here, so if I adjust this up to 10, larger price fall again. You see we're getting some pretty good trades, but so few of them that it's difficult to apply much significance to them. Good percentage of winning trades as well. Stop loss seems to work pretty well. If a stop loss works well, it suggests to me that we're getting the timing right on these strategies, so maybe there is something in it, but we're going to have to increase the number of trades because we can't have 7 trades over 22 years. So we'd have to monitor a very wide range of markets, test over those markets and find whether this is indeed significant. Hope you have enjoyed this video showing you what I have been doing this week in my analysis on price indicator divergences. If you'd like to learn more, if you'd like to get this spreadsheet, there's a link below this video. Please subscribe to this channel for more content like this. Please like this video if you did indeed like it. And for more information about trading the financial markets and in particular backtesting your trading strategies, please go to tradinformed.com.